Hi guys, happy Sunday and welcome to another webinar. And today's webinar is going to be slightly different, mainly because I have a guest with me today and she is very new to, the FX game, and she's very new to the market. And I'm just going to show her, I'm not going to show her any charts or anything. I'm just going to show her current strategies that we have. And I want to know how, new people perceive the market. Okay, so she might just hop in every now and again, just ask me a question if she needs clarity. That's fine. Just letting you guys know ahead of time. I just want to keep this as real as possible and keep it as smooth as possible. Okay. So for those that have been here a while, you guys know the strategy. For the guys that are new here, welcome. And in this channel, we look at three strategies. We look at seasonality. Then we look at COT. Actually, COT, I look at COT first before I look at seasonality because it's easier that way. COT, seasonality, then probability. Now, okay, so COT is called Commitment of Traders Report, and it's mainly for commercials. So we're talking about people like maybe they want to produce a mobile phone and they need to buy gold from China, for example. They need the local currency in China to buy that gold, right? So these guys, let's say companies like, let's say Apple, for example, would bargain with someone in China saying, look, I want to be able to buy, 1 million worth of gold or 10 million worth of gold, and give me the best price currently in your country. Now, when they give me that price in their country at the moment, because I'm paying them in dollars, I need to change my dollars all the way to their local currency, right? So there's an exchange going on. So during that exchange, there's a fixed price that you will get. Now, the main reason now, me as a commercial, what I do is the main reason I buy this stuff is I might not need it right now. I might need it to produce something in 6 months down the line. And I buy it right now because I believe the price is best at the moment, because I do have friends in China, for example, or people in politics in China telling me, look, the economy of gold is going to be this, that. And hence why we copy them. And that's what we do with the COT report. We copy those guys straight because they have to give that information out based on Freedom of Information Act. And we get access to that information once every week. So what we look at is just the commercials. Those are the people like, companies like, let's say Apple, Samsung's and all of that. And non-commercials are people like you and I, some banks in there. Non-reportable, I'm not quite sure who these guys are, but these two are who I'm sure of. So we follow the commercials, right? And we don't really follow anything except from this right here, the changes, right? We check if they're going long or short. Long means you're buying, short means you're selling. Now, in some cases, you will have it looking green plus 2,000 position here, and there could be another plus 2,000 position here. That means they're buying in the long side and they're also buying in the short side. So far, so good?
Yeah.
All right, cool. So what's happening now is we look at gold, for example, and we say commercials. We're looking at commercials, the changes, which is long. Right now, as of last week, they were buying 2,000 new positions. So we put in COT report, we put gold, we put long. Now, that's all we need from this page. So we're going to take that out. And then the next thing is here. We look at Swiss franc, and we look at commercials. Now we see they're taking our position from their short and their long side, right? We don't really know anything here, what they're doing, so we just don't touch that. The next thing we look at is we look at Japanese yen. They're adding 6,000 position to their long and they're 4,000 to their short. Now, it's giving a conflict signal because they're buying and they're selling at the same time. So we only want to know if they're only buying or if they're only selling. So because of this, we will not touch this trade because it's a buy and a buy as well. So and a sell at the same time. So we don't want that. In this case, we have Euro, for example. So we only see now that they're going short, which is the sell side. So we take the sell. So what we'll put here is we put Euro. Then we're going short. Right? And the next thing we do now is look at USD. We're seeing they're buying and selling. We don't need that. And then we look at Canadian dollar. They're buying 12,000 positions. So what we do is we put CAD. Long, you can put buy, whatever, I just understand it that way. And NZD, we have them buying as well. So for NZD. Gosh. Well, okay. So There's still more, but I don't want to go into more. You get the gist, right?
Yeah, I get it so far.
Okay, so far not complex. Now the next thing we look at is seasonality, right? Seasonality is, you're familiar with the season in the year. We have summer, autumn, spring, and winter. And in the market, you have Q1, Q2, Q3, Q4. In every stage, is the market move totally differently, right? And we want to know in which season are we in? Are we in the up season going up, or are we in the down season coming down? We know the market can only go up, down, or sideways, consolidate. It doesn't go anywhere, which is stuck, right? So now we know that in gold, we're expecting it to go up. In euro, we're expecting it to come down. In CAD, we're expecting it to go up. NZD, we're expecting it to go up. Now, in seasonality, we want to confirm if gold is actually in its buy season, which is the up season, right? And we want to also confirm if euro is in its short season, which is the sell season, and Canadian dollar if it's in the buy season, and NZD if it's in the buy season, right? So far, so good, right?
Yeah.
Cool. So what we do now is in the tool, we go to here, we go seasonality, and we look at the assets we have. So we have gold, we have euro, we have CAD, we have NZD. Right, so what we'll do is we go for gold first. Let's see what we have in gold, right? So this is gold. This is what the seasonality chart looks like. It might not be what you're thinking about, like, season, full season, but this is the start of the year. From here, you can see 1st of January all the way to down here, 31st of December, right? It's an average of the past 5 years, 15 years, and 47 years. So let me just take it out. In the past 5 years, up until 2021, this is what price have done. So we're talking about 2017, 18, 19, 20, 21.
So it's been going up gradually.
Yeah, it's been having an average of up. It's not going up gradually, but we're saying this is what it's been doing consistently in those 5 years. Okay. So we have, like, for example, in 23rd of February, price tend to normally drop in gold.
Right.
You understand? And then it start picking up from around 13th of February. It's best to buy gold around 13th of February. So that's what it's telling us. And what we look at is we look at the 5, 15, and 47 years, because 47 is the max data that we have. And what we want to look at is where they align together. If they're overlay, like here, for example, they align for a long period of time, we take that as a good signal, right? If they are somewhere like this, for example, they're misaligned, they're not in the same stable, we don't take that trade.
Why?
Because when they're misaligned, right, it means the market is not sure. In the past 5 years, it's been showing up, but in the last 15 years, it's been showing down.
Right.
So where do we go? Do we really go up, or do we really go down? Even if COT is telling us to go up, for example, to go long, and that's also one of it is telling us to go long, because when it's saying down, you rather take it at being safe. You don't want to always jump the gun, in the sense that you want to be patient. You want everything to align the way it is. That gives you the best possibility of winning the trade.
Okay.
Now, a lot of new traders, and I've made a lot of these mistakes, is because I want to trade so bad, even if they do not align like this, because I'm seeing COT telling me that, oh, this is looking good for long, and this one of it is telling me it's looking good for short. So I take the trade. Then I end up losing that money.
Because they didn't align.
And because of I am so itchy to make money.
So even though your COT says long, you also have to make sure that they align.
They're also aligned, on the seasonality chart, and on all 3 averages, which is the 5 years, 15, and 47. All 3 has to align. So I was trying to keep this session to 10 minutes, but we're almost touching 10 minutes. So for this session, guys, I'm just trying to make sure, taking someone all the way from the start, because every week I come here, I've been doing this for maybe the past 5 years now, doing this consistently. And I don't, look at it from the perspective of someone else. So I'm having someone else right here trying to see them ask me real life question. And these are stuff I've spent years learning, just trying to push it out there to you guys and push it out to someone new. I'm literally giving you knowledge that I've pride for. So, this gives you a perspective. I'm trying to see how short I can condense all of that knowledge to, and see if you can understand it. If you can go from 0 to maximum level in a very short period of time. All right. So now we are at the date of 20th of August. So what we know so far is gold is long, right? So we want to wait for the 20th. Want to look at 20th of August right here and see if it's also going up. So
it's going up, but
yeah, you can see that.
We say it's aligning because it hasn't overlapped.
Yes, so it's not really aligning the way we want it.
Right.
Because if we go in the trade, because we say it's going up, right? Let me see. We're right here, right now, right here, right? The chart is telling us that it's going up, but we can see that from the 45 years, for example, tomorrow there's gonna be a dip. The 15 years, which is the red one, 5 years is the blue one, 15 years, which is the red one, we see that most likely is gonna go up, and 47 years most likely gonna go up. So we wouldn't take that trade tomorrow, but we can look at taking it on the 29th. So let me just zoom in a little bit more, maybe make it a little bit clearer. So where is it now? So we can look at going in around this period of time, 29. And we want to see a good stretch of days before we go in. So 29 doesn't even look the best. Right here looks the best. 30th looks the best.
Or probably, is it the 31st?
No, we take it from the base 30th because
Right.
it's that's the lowest point. It got to which everything aligned.
Okay, so you have to start with the lowest point.
Yeah, lowest point. Because if we took here, for example, this was the lowest point for the 5 years,
But
and
the other
one of
two
the other two, look, the lowest point for this one was here, for example. So we have to take even this one now. We have to take that into consideration.
Okay.
So
30th.
yeah, so we go from 30th all the way up until the 2nd, right? That's what we have before it start coming down, crashing down. So say 30th. So we go 30th till 2nd. Set. So all right, so we take it from 30th of August to all the way in September. And the same thing we want to do, and that's basically long. So it's going up, just to remind ourselves that we're looking at it going long. Right?
So you do this for each of the
these ones. So for Euro as well, exactly. Now, normally on Forex, for example, we know that it's Euro, USD, this one, that one. Now, but we're taking them singular first. We're looking at just one, rather than looking at the both, because in Forex, you have to trade one currency against the other, because if you're changing a euro, you may be changing it to dollars or pounds or whatever. But we're just looking at euro on its own, seeing if euro on its own is strong enough candidate to go fight an international war.
Okay.
You understand? So we're trying to gauge the strength of the euro at the moment, just like we gauge gold, right? So the same thing happens here. We're at 28. This is what we're seeing right now at 28. And euro is looking like a downtrend, but the down doesn't look like it's aligned till somewhere around here, the second. But then it doesn't last more than 2 days or 3 days.
So what does that mean?
It's not good, basically. It's not looking good. You want it to be looking as smooth as possible.
So how many days do you consider it to be smooth?
I see about 5 working days, 7 working days, because that's a week.
Okay.
Right. So in a week, there's a lot that could happen. It could go up and down, but it ideally would go towards a direction. But if you have 2 or 3 days, if you make an error within that 2-3 days, then you don't have anything to recoup. So you have to give your trades enough time to mature. Some people like to trade like within 5 minutes, 10 minutes. I don't do that because that's stress. You're gonna grow gray hair very quickly. You don't want to be scalping too much. I mean, a lot of people. I mean, I don't doubt it, but I've done it before, and I know that I end up
based on, I guess, your preference.
Yeah, basically. Okay. You can do a short time trader, which is to scalp. You can do swing trading, which is similar to what we're doing right now, and you can do seasonality trade, which is what I'm doing right now. Seasonality trade. It blends in with swing trading.
What's the difference?
Seasonality trade, I can hold a trade. Let me give you the example. So let's say, for example, euro right here. I take the trade from euro right here in March, 29th of March. I hold that for a whole season. I come out in 1st of May. Now, swing trade is I take a trade right here and I come out quickly right here like gold. The one I want to do is 5 days. So any trade like really like 5 days is about swing trade.
Okay, anything longer.
Anything longer, then you're going into seasons, because seasons are the bigger. You have 4 seasons in a year. You have Q1, Q2, Q3, Q4. So if you can hold one from Q1 all the way to Q2, that's a season trade.
Yeah, makes sense.
I'm saying, so it's kind of like you're playing a football league, right? You have seasons that you're playing. So euro right now doesn't look that good. You know, we're expecting it to go short, but from what we can see right here, 28. I mean, it does look like a short from 28 right here, but it only goes for 2 days till 30th before it kicks back.
It's not enough days. Yeah,
basically, I won't touch that. Then the next thing we'll do is go into CAD, look at CAD, and the same thing. Well, if I wasn't explaining this, I mean, we can literally knock this into a 7-minute, 8-minute session. And that's literally heavy trading, to be honest. And the beauty of this is once you know this, you can actually automate it. Get a robot to automate, feed this data into a robot, and then the robot takes the trade for you. So you don't even have to look at this. All you look at is results over time. So it takes away all the emotions from the game. All right, cool. So next thing is we'll look at 20th for CAD. CAD looks like it's gonna fall. They don't really align. So we don't take CAD. So For that reason, Euro and CAD, I'm just taking both of them out of the equation. Did you see that properly, or should I go back to
No,
that?
I saw that. That's
All
fine.
right, cool. And then last one, NZD. I mean, there's still other trade. I didn't look at GBP, and neither did I look at AUD. And no,
But you would still do the same process for
the
those.
same exact process for every single thing.
Okay.
Go ahead. I mean, but this should be like a normal bread and butter if you want to trade. Just rather than looking at charts and looking at the price movements or going up and down and all of that. You just tend to. So we're 20th right here. So with this one, it looks good, showing that it's going down from probably 21st, and this is a good amount of swing. 21st. So what we look at is it's telling us it's going down, but the COT is telling us that it's going up.
Right.
You see the dotted line?
Yeah.
So that's a trap right there. Which one do you believe?
Right.
You
So
understand?
what would you do?
I wouldn't do anything.
You would take that
I wouldn't
out.
take that trade. So
Right.
this is how you eliminate trades that's meant to get you into a trap.
Mm-hmm.
So by just looking at those two different data sets, they give you an angle into the market that most people don't get. You might be looking at the COT alone and you're thinking, oh yeah, it's going long, it's going long. I go into the market and then boom, it shoots the other way. So now, or you might be looking at seasonality, just people are using that only. And they think it's going down, 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 boom, and it goes up. So in situations like this little extra gives you confirmation of what you should do. And then the last tool is probability. Now we have the dates. I can go in on this date, for example. But what happens if this date is on a Saturday?
I don't know what happens.
Then we have something called probability.
Okay.
Probability literally helps us mitigate and gives us, it's kind of like a casino way of looking at the market, right? So every game that you play has a chance of you winning or you losing, right? There's a percentage towards your side. If it's a 51% chance, if we're playing a game and you have 51% and I have 49%, if we play 100 times, you're going to win 51%, and I'm going to win 49 times, which means I lose, you win. You understand? And that's the same way the probability works. It shows us the dates that I want to go in and tell me if that direction is the right direction I should go. What's the percentage of it going my way during that time? Okay, so we're going to go. I have it for the whole year for the probability for this. So it goes all the way to the end of the year. And what we do now is we're knowing that gold, for example, when it's go long and want to go from the 30th up until the 2nd of September. So what we're going to do, August, we're looking from 30th, we're looking to buy. And till September, so we're looking to go long 30th to September 2nd. Now, 30th right here of August, we can see it's telling us the best chance on that 30th is actually sell.
Okay.
Are you confused?
Yes.
So August now, we're looking at gold, same asset gold.
Right, I understand. Yeah.
So we know we're meant to buy, we're meant to go long, which is buy. Should I change that to buy? No, so probability also has to say buy. If this is saying buy, this is saying buy, this also has to tell us we should go buy. Right now we're checking August on that same date that we want to check. I mean, it looks like 3 different tools. We looked at one that looked like a table, one that looks like a graph, and this one.
Okay. So
now we go to the 20th, right?
20th, yep.
So 20th is what's it called? Sunday, which is today, right? Okay. And wait, when did I label this? Wait, did I make a mistake?
You said 30th of August.
No, that shouldn't be correct. Why should I check? I'm checking because the date is 20th. And I'm
that's why I was a bit confused. Like,
all right, give me 2 seconds. Let me just quickly run back to the probability seasonality. 2 seconds. We'll check the seasonality of gold again just to get that date right.
If you guys noticed the error earlier, comment down below so we know.
Okay. I mean, during the live session, I've had that, being noticed a few times. I don't know why. Maybe I'm just running too fast. All right, let's go back, check this. So we are checking the 20th on the 30th. And the real truth is, if I could have made the same error on the other one. So yeah, there's a high possibility. So yeah, so
but it's fine because then we know if you're doing it for one, just do it for the other.
Yeah, for the other. So it's actually what we're looking at is actually here. It's not even 30th anymore. It's 20 something, which is still the same thing. It's actually still the same. It looks like a long, but we're not gonna go in here. Now that we're gonna go in there, we're gonna go in somewhere around here, 24th.
Yeah.
Around 24th would be one of our best option to go in. So 24th of August is our best option to go.
Till when?
And yeah, that's actually correct. 24th to 2nd.
Still the 2nd.
Yeah.
24th of August
Yeah.
So the 2nd of September.
Yeah. 24th.
Okay.
Okay. So now what we're going to be looking at is the
Seasonality.
seasonality. So we know on that, no, not seasonality, probability.
Sorry, probability.
Yeah. So now we are the 24th of August now, where we're meant to go, which is on Thursday. It says a 50-50 chance. So we can't,
Okay.
we shouldn't go in on that day.
Because you want it to be more.
You want it to be more in your favor.
Right.
Now, the next day after that is 25th. 53% chance against you going now.
Yeah.
You don't want that.
No.
The next day that you have, which is a working day, is the 28th.
Right.
Which is a 56% chance.
Yep.
But I wouldn't take that because I needed to have 3 days back to back like this. 59,
right, okay.
52, 56.
Okay.
You understand? So this doesn't have that.
Yeah, it's not looking good.
It's not looking good all the way till September, which is right here.
So then what does that mean then? Which
means that this trade is a very risky trade and I wouldn't take that trade.
Right.
So basically, I've done all of that to nullify all those assets, saying I'm not taking that trade unless the assets fall into that tiny category. Then I'll take that trade. Now imagine if you're a day trader and you're relying on this to make money. You understand? You need a massive amount of money to actually rely on this, because if you have a small amount of money and you try to turn a very huge amount of gain with this strategy, you're going to be there for a while. So it's not that you need so much money. You need to be patient. You need to make this like a secondary income, not your primary income, because if you turn it to a primary income, you'll be so itchy to trade even when it doesn't align. Just like now, and we have these two aligned, you could lose so much money. So that's what the trap a lot of people fall into. So what I'm trying to do now is, if we can now turn this and automate all of this system, now we can now have a wider variety of assets. Let's say, for example, we can look into stocks, for example, we can look into a whole lot of assets at the same time. So it's now about a numbers game. How many assets can you look into at the same time? And if you're looking at 100 assets, maybe out of that 100, you might have 3 or 4 aligned for you, and then you take those 3 or 4. Okay. You understand what I'm saying?
Yeah.
So that's the trick right here, rather than just looking at 1 or 2. So guys, if you really, want to know more about this, what you can do is go to the website, business.dmempire.co.uk/pricing. You can put that in the back, and it will give you access to any of these tools that you want to gain access to, and you'll be able to utilize that to have a variety of scan about the market and see which one falls in accordance to your own strategy. You can use this with your own personal strategy, mix and blend, whichever way you find it. Of course, this is my own personal outlook into the market. It's not, I'm not saying this is like a know-all advice or professional advice for you to put your entire money or life saving into. I'm just saying this is my perspective of the market. Okay, so thank you very much for attending this week, and I'll catch you on the next one. There's so many other trades that is most likely viable, but I hope you've learned something from this. Was that quite easy and quite knowledgeable to learn?
That was good. It was good information.
I mean, don't lie to me. Tell me if that's
it was good information. Yeah.
Okay. If it's easy for someone that's never known about the market to learn, then I mean, I'm glad with what we have right here. All right, guys, take care of yourself, and we'll catch you in the next one.